Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Axel Ragnarsson. Axel is a founder of Aligned Real Estate Partners, a real estate investment firm that purchases multifamily real estate in various markets throughout the country, such as Florida, Indiana, and New Hampshire. Currently, Aligned Real Estate Partners owns over 300 units of multifamily real estate value at $35 million plus. He also hosts the Multifamily Wealth podcast, one of the most highly rated podcasts in the industry, where he interviews real estate investors and dissects how they start, built, and scaled their businesses. Welcome to our show today, Axel.
Awesome. Thank you for having me.
Yeah, awesome. So Axel, we always start our show by asking people, when you're thinking back growing up as a child, who and what incidents kind of shaped you become the entrepreneur who you are today?
Yeah, it's a great question. And, for me, I think I just had a very entrepreneurial upbringing. So my mom and my dad ran a company that manufactured and sold wood chippers. So nothing to do with real estate, a little bit of a different business, but it was a business nonetheless. And they certainly had some success doing so. And for me, I was just exposed to that very early on. My dad was someone that all the time was talking about, if you're going to work and you're going to work for a long time, you want to build something. You can work for somebody else, but if you're going to do that, work for someone early in the company, right? So you can take some ownership of that company or work in a really high commission job so that the longer you're in that, your income compounds versus, just increasing at a really linear level. Yeah. And for me, that was something that stuck with me early on, where if I'm going to be working at something in any capacity, business, real estate job, whatever, I want there to be some exit, some reward that's outsized and different than just getting paid along the way. So right. I always knew I wanted to run a business, and I was doing everything I could to make a dollar that wasn't working a job early on. So I was the guy that was selling the Xboxes and flipping cars and making all these monies into different, money in different ways. And that eventually led to real estate in college, where I found the real estate business because I wanted to flip houses. And then after learning about flipping houses, I was like, that's kind of a labor intensive, difficult job with a lot of risk. And along the way, as I was learning about flipping houses, I learned more about multifamily real estate and rental real estate. And that's really where my focus shifted and started to try and get into that business early on. And that's really how I got into real estate initially.
That's awesome. And you mentioned to me earlier that your team really kind of focused on purchase and operating some of the small properties, small multifamily. Essentially, in multifamily, sometimes people will call, the unit sizes that you're in the no man's land. Can you tell us how you make huge profits from the no man's land?
Yeah, I like that. I actually haven't heard that term, but that's pretty much what it is. It's that's why we focus, because there's not a lot of eyeballs on it, right? And to define it, we look for 20 to 80 unit deals in a lot of the markets that we currently have properties in and that we operate in. So Indianapolis, Central Florida, and then up in New Hampshire, which is my local market. Originally from New Hampshire and live in Boston, so that's kind of in the backyard. And for us, the way that I look at real estate really at a high level is it's a market that's inefficient, and the people that can capitalize on the inefficiency are the people that make the most amount of money. So when it comes to selecting markets or selecting a criteria within a market, I want to look at the deals that not a lot of folks are looking at, and where there's the highest opportunity to actually find value, because there's not a lot of buyer demand or competition, and it's the most inefficient. So that's the reason why we look in, for example, Central Florida and Lakeland, Florida, Bartow, Florida, Winter Haven, Florida versus Tampa or Orlando, because there's obviously significantly higher competition in those markets. And even if you're looking in, the quote unquote no man's land, you're still competing with local folks, regional folks, national buyers. And it's just the likelihood of finding a discounted deal are significantly lower. So when we think about what we want to buy and where we want to be in markets that are still strong markets, but not like the tier one or even really like the tier two, really popular markets that everyone's talking about on the podcast that, are showing up on the Business Insider and the Forbes post for fastest growing cities. Like, that's not where we want to be, because we're not finding great deals day one. And for us, and for me personally, the greatest way that you can mitigate your downside risk is you just buy right day one. And it's just your risk is significantly alleviated when you buy a property that's worth $100,000 a unit for $85,000 a unit. Like that's the best thing you can do as an investor. And for us, the easiest way to do that is to focus on these middling deals that are too small for a lot of the larger players and then too big for the smaller local guys or girls. And that's kind of where we carve out a lot of what we do. And we still do some larger deals. And we still do, a lot of my personal portfolio that I don't have investors or partners in is smaller, right? It's 6 to 12 unit deals.
Yeah.
So we kind of play on both sides, but from a standpoint of we want to really actively pursue these deals in the middle where we're sending direct mail, we're cold calling, we have a full-time acquisitions person on our team. Like that's where we want to spend that energy and that money to find deals is in that middling, area.
Yeah. And then can you speak to some of the challenges, some of the reason why, we kind of in the industry call that area like a no man's end, as in like the challenges of the 20 units to 80 unit, sizes, typically, and then how do you like actually overcome it and then make that into a asset versus, a possible liability? Yeah.
Absolutely. So there's the two main challenges, and I think a lot of folks are kind of familiar with really one of them well is, first it's management and second it's financing. From a management perspective, the reason everyone loves to do the 80, 90, 100 plus unit deals is because you can afford to have an on-site manager, on-site maintenance person. Depending on the unit size, you may need maybe one or two, or you might need a couple of other folks, but the deal is large enough to justify having someone on payroll on site, providing a great service to all the residents. And then in aggregate, your overall management fee is a little bit lower as a percentage of your gross income. And so there's some benefits of the scale there, right? And if you're doing a smaller deal, and I've actually really found that this is the case in the 40 to 60 unit range, if you're at like 25 units, there's not even a question of having somebody on site. Like that's just not going to happen. You're going to have a third party management company. They're going to charge you 8-9%. And that's going to be how you handle management. But once you start getting to kind of that 40, 50 unit range, it's a little bit too small to really justify, even somebody almost full-time, part-time, but it's still too big for someone to not be on site all the time. So that's really where we've had some challenge. And oftentimes your management spend is going to just be a little bit higher as a percentage of your gross. Comparatively to some of the smaller deals or the larger deals, because you still want to have an individual on site, especially if there's an office there, right? You want that office occupied. So that's the challenge with the smaller stuff, is that component most significantly, right? Like that's the number one challenge. And, something we've done to alleviate that too, before I get to financing, is if we're going to buy a small deal in the market, we want to get a second one there as quickly as we possibly can to share resources. So if we're going to buy a 30 unit deal in the marketplace, we want to quickly buy another 30, 40, 50 unit deal there, so that in aggregate between the two, we can, that on-site manager can drift between the two, spend 20 hours at one, 20 hours at the other. And then as a percentage of our gross income, that management spend is a little bit lower. So the way to get around that is to get really active, right? And just go get that second deal as quickly as you can, or narrow down your focus even more to that smaller end, right? That 20 to 35, or the larger part of that, the 65 to 80, because in the middle is typically in most markets where there's the challenge. And then the second big challenge is financing. And really the financing challenge is your terms just aren't as great as the big deals. Right. The bigger the deal, the better the financing terms. You're going to get better financing terms in a 500 unit, then a 50 unit, and then a 5 unit, right? So in the middle, you still get more competitive terms than buying a 6 unit deal, but it's still not as competitive as the large stuff. And it's harder to find non-recourse. That's the big thing, is a lot of the debt is recourse. So there's more risk involved at the sponsor level. And that you're personally guaranteeing a lot of the loans that you're going to do, especially if you're working with local banks, local credit unions, bridge lenders. Fannie Mae and Freddie Mac will work with you on a small balance program, but oftentimes it's Fannie and Freddie, like especially today, we're recording this late April 2022 here. They're just, the terms are worse from a Fannie and Freddie perspective comparatively, almost across the board to local banks and credit unions, because of the prepays, the yield maintenance, lower LTVs, all that stuff. So it's trickier to nail down the lending, and it requires a little bit more work than some of the large, if you're at 100 plus units and it's a $10 million loan, call up your debt broker, they shop it out. There's a ton of interest in those deals,
Right.
and you're just going to get better terms. So it's financing and it's management, management really being just the big number one piece.
Yeah. And do you feel like you're actually getting a better deal with your property manager? Because now all of a sudden you're like, hey, you're managing almost 100 unit for this. Potentially you can give me a better rate than someone who is only managing 30 and 40 units.
Mm-hmm. Yeah, over time, as we develop a relationship with a property management company, when we start out, it's usually some kind of a fixed rate, and then we shoot to get that number down the more properties that we bring to them.
Mm-hmm.
But the challenge is still, you got to get to some critical mass to justify having somebody on payroll.
Mm-hmm.
And it really depends on the unit, and in some markets, there's no need for like somebody on site, right? And so in Boston, for example, if you're doing a 30 unit deal in Boston, that's a massive, from a purchase price and a rent standpoint, that's a really large deal. You could afford to have somebody on site there if you wanted to.
Yeah.
It probably makes sense, but you still don't even need to from a management requirement standpoint, right? So you have much more flexibility in a higher priced market. Whereas when we're in Indianapolis, where average prices are 70 to 90,000 a door, average rents are a little bit lower. And we have a full-time person that, hypothetically speaking, if we had a 50 unit asset in that market, we have a 23 unit there. So we don't need somebody on site. But if it was 50, that's a much higher percentage of our overall income, right? So right. It's almost, each market's a little bit different, but that's the big question. And you have to really get on the same page with your management company. And what we really try and do is minimize the need to have somebody on site. So if we have we're working through this challenge with a deal down in Florida right now that's 48 units that we're going to be closing soon, and there's somebody on site there now full time. We want to keep them on, and the challenge is their salaries or percentage of our gross is huge because their average rents there are lower. So we're trying to figure out, hey, how can we manage this with a part-time individual? We'll bump your management fee a percentage, and you can send somebody there every couple of weeks to really keep an eye on the complex and everything like that. We'll narrow down the leasing hours. So you have to get a little bit creative, right? And some property management companies, especially the large ones, they just don't want to deal with this. They're like, now, if there's not somebody there on site, like we're not even really interested in figuring this out. So you really have to find the right management partner with this stuff, which we do in the markets that we buy. And that's a big focus of ours.
Yeah. So, and then you basically invest remotely, right? Like you don't live in Florida currently, do you? So
no, I don't. I live in Boston. Yeah. The only real market that's kind of the local market is we do a lot of business in Manchester, New Hampshire, which is an hour north of Boston, but it's still an hour away. I see the properties that I own up there once a quarter, so it's not like I'm up there all the time by any means.
Right. Exactly. Yeah. I used to own property in Tacoma. I live in Seattle, and I own property in Phoenix. And I was like, I see my property in Phoenix more often than I see in Tacoma. But interesting. And then, so how do you find the success in like remotely managing? Because that's another hunch. People who are investing are making themselves thinking that I can't manage remotely, especially with small property because they're high touch. How do you kind of find the solutions to that?
Yeah, it's a good question, and it's definitely a limiting belief of a lot of folks, I think, and it was of mine for a very long time. It took me forever to go out of state, and I knew I needed to and wanted to scale the business, but I could never really get there mentally. And after a while, you kind of just realize like what's different down there that it is in my backyard. If I'm driving around Manchester, New Hampshire, looking at my properties, it's not like I'm banging on the tenant's door and trying to walk around. I'm just like, I drive by, all right, it's still there. There's no trash outside. Good. Right. So it doesn't really change that much when you think about it in that respect, where even if you think about how much you look at what you do locally, and it's probably not that much, like you just mentioned, right? You see your properties in Phoenix more than the ones in Tacoma. And I think that from a people standpoint, you can put the right people in place to make you feel really comfortable. First and foremost, you need a great management company. None of this matters if you don't have a really, really good management company. So once you have that checked, that box checked off, then you can go to the second level, which is managing them in an intentional way to make you feel more comfortable about what's going on. And this is really true for the CapEx part of a business plan where you're doing renovations and there's, more moving parts than just picking up rent and answering maintenance calls. So what I like to do is regular FaceTimes, right? Every 2 weeks, I have a time on my calendar to FaceTime my property manager in Indianapolis, right? And we walk around on, here's the side of the building, here's how the exterior paint's coming along, here's the inside of the unit, we're making this kind of progress. And that really makes you feel comfortable. And then if you know people in the markets that you're buying in, throw somebody $75 for an hour of their, half hour of their time, whatever it is, your broker contact, a business partner, somebody, meet somebody out there and you say, hey, I'd love for you to go walk this property with my property management company. I'll pay you for your time. Let me know how everything looks. How do the hallways look? How did the lighting come out in the hallway? Is it bright? Is it effective? How's the parking lot restriping going? Does that look good? Send some pictures. So there's ways to solve it. And I think that just because people aren't there, they're just like, how do I know that everything's happening? You can get your eyes on. I mean, it's the 21st century. There's a million ways to physically get your eyes on a place if you're not local. So I think embracing all of these different strategies is really helpful. And then from a buy side perspective, which is where the real hurdle was for me, how do I know it's a good area, a good market, good street, that the property's not falling apart? Well, understand that it's going to take some money to figure that out. If you're going to put a property under contract, you better be prepared to go down there for a few days and walk the property and walk every unit and drive the neighborhood. And, you should get a feel for that before you go into contract, obviously, but that's also part of it. So just as you do a home inspection and property inspection on something locally, you do the same thing from afar on a deal in another state. It just costs more because you got to go there, right? So understanding that that's part of the transactional process and mentally committing to spending the money on a plane ticket and a couple of nights in a hotel is critical too.
Yeah, definitely. Absolutely. And how do you find these deals? You kind of talked about, actually rewind back a little bit. I'll ask my last question about management stuff. How do you find your manager? Because, it takes me a couple of tries to find the right management company. I mean, that's really a key over here. So how do you actually find, good manager, especially when you're managing remotely?
Yeah, that's a good question. So it just takes a lot of conversations, I think, is the best way to put it. What we do when we go into a new market and, we start looking at deals and we want to build out our team is we find a high number of investors that are doing a lot of business, that own large portfolios that we would consider to be successful. So we tap into our network, whether it's LinkedIn or some networking groups we're in, or we go on a site like Bigger Pockets or something, and we build a list of all of the investors that do a lot of business. And then we do the same thing with agents and brokers. I want to know the 5 brokers that do, 5 of the top 10 brokers, really a lot of the brokers that do the bulk of the business. And then we ask all the brokers and we ask all the investors for management company referrals. And eventually you're going to get to the point to where there's a couple of companies, 2, 3, and probably 1, honestly, that's getting all of the referrals. So, A players just know A players. So you ask all the A players who the management A player is, and then they give you their glowing endorsement for a company they've worked with. And you probably narrow that list down to a few, and then that's when you go into your traditional due diligence. You look them up online, you give them a call, you interview them. How many units you guys manage? What's your process look like? Kind of software. Can you give me some referrals to owners that you have managed for in the past or currently managed for? I'd love to chat with them about the experience they've had with you. What's your pricing? All of those different questions that go into that conversation. But we're really, really referral based. If I know that this investor that I respect and I think is a really smart individual and they own a really good chunk of property, and they're saying, hey, this is who we use, we swear by them, I'm honestly probably just going to use them, right? Go through the screening, but once you screen them and everything works out and you set your expectations, I mean, this is the other piece too. You really want to set your expectations as to how you like to work as a client. I want biweekly phone calls talking about the progress of a business plan. First few months, I might want weekly phone calls, depending on how intensive it is. This is what I want to see on a monthly report basis. These are the KPIs I want to see. Once all that stuff's good and they pass the interview, the big thing is just the referral, because that's really what matters the most. I never do anything without referrals. I'll never look up a list of management companies, for example, off Google and then just start interviewing them, because I have no sense of, going into those conversations if other people think they do a good job. So for me, it's find all the great brokers, find all the great investors, and then you can go a step further and find the great insurance brokers or the great management companies, because they know too. And then just see what names pop up pretty frequently.
Yeah, that's awesome. That I definitely agree that referral is the way to go. But there's a lot of tangible tips that you have given to our viewers in terms of how to go about this. Awesome. So let's switch gear a little bit. You mentioned that you guys also work on the bigger projects as well. So what capacity are involved over there? And then what is the strategy play over there with the bigger units?
Sure. So we still look for larger deals as well, just less aggressively than those middling deals, the no man's land deals. And so we still try and find them so that we can take them down, operate them, raise the money just as any investor would. But we also partner with a lot of other folks on bigger deals. And really, we just try and find opportunities where there's a synergistic relationship. So we are always networking with folks that do 100+ unit deals. And I mean, even smaller deals as well. But usually we find that this happens on the larger deals because the pie is bigger to slice up, so to speak, where maybe there's a need for some assistance in the capital raise, or maybe there's some need to help with asset management or something along those lines. Or maybe there's some need to sign on debt or something like that. And we'll come in and participate and partner on the deal. And most frequently what we do is we help to raise capital for the deal. And then we participate on the general partnership or in some other capacity in an active way. And really the goal for us is, sure, we can build relationships. That's great. We get into these larger deals. That's great. There's an opportunity to make money, obviously. But for us, the goal is to keep our investors engaged and active. Really, is the fundamental goal of partnering with other folks on these larger deals where we're coming in that capacity. Is it's easy for an investor list to go dormant, right? I think that's the challenge a lot of real estate investors have, especially those that are raising capital, is if you're out there hustling for your own deals, if you're really, really active, you're maybe doing one deal a quarter. Like that would make you really active. If you do 4 deals a year where you raise all the equity and you operate it, yourself or your team, that's a good business. That you're a pretty busy individual or a busy company. But there's oftentimes where you have a longer stretch between those deals coming in where, maybe you do a deal in February and your next deal doesn't come until June, right? And you have all this time. But in order to grow the list, to gain referrals, to continue staying active, you have to give them opportunities to invest. And oftentimes a way to do that is to partner with other people on their deals. So I think that's something that we've done well, is sprinkle in these opportunities along the way, even though maybe there's less upside for us because we're not operating it and there's, less of an involvement on our end, but we can still bring great opportunities to our investors, right? That's the first and foremost goal. And it allows us to just bring more opportunities, stay more engaged with them, and ultimately do more business.
Yeah. And then diversify their portfolio as well, which is also something for the investor purposes too. Yeah,
exactly.
Awesome. Well, tell me a little bit about your podcast. Tell me a little bit about your podcast and how did you start that? And how did you find the success in this land of a lot of competitions?
It's I like to call it a labor of love. It's been successful in driving some activity to our business, whether it's partnership opportunities or some investors. But really the reason I started it was I didn't necessarily have like a clear objective. Some people want to go sell educational content or courses or mentorship, and some people want to use their podcast to grow their investor base. For me, I was like, I'll start it, right? I got some time and get to chat with other folks and network with people and learn more about the business, keep sharpening my axe, so to speak. And I think that for me, that was the goal for like the first 50 episodes. There was no like call to action, which is crazy to think about. It's a complete violation of marketing 101, but we're up to 90 or so now. And now it's becoming a pretty good lead generation source. I'm starting to push people to our business, aligned real estate partners. And in terms of finding, gaining traction and having some success, I think a lot of it comes from the fact that I'm really active on social media. So for example, on Instagram, it's not like I have a huge Instagram account. It's got a good amount of organic followers and I'm really, really active on there. And I'm constantly posting unique content, a lot of stuff that I'm learning in my business as we grow it versus more high level, fluffy stuff, right? Like what's a preferred return or this is what real estate syndication is. Like I'm taking people behind the scenes. Like this is what we're learning as we renovate this project. Here's some numbers from a recent deal. This is a mistake I just made and what I learned from it. So for me, I post a lot on social media. So I've grown a following there. And then that therefore drives a lot of listeners to the podcast. So if anyone's out there is looking to start a podcast, I think that's a really good approach, is develop your social media presence. And there's easier ways to do it than growing an Instagram account. That's a really hard thing to do nowadays. It's not easy. So, go on TikTok or start a YouTube channel or get really active on LinkedIn. People that are really active on LinkedIn right now are having a lot of success in growing a podcast quickly. So think about all the lead funnels that
Mhm.
then feed to the podcast audience base, and develop those while you develop your podcast versus just solely producing the podcast, because it's hard to get the word out. There's a lot of real estate podcasts, a lot of podcasts in general, and people can only
Mhm.
listen to so many.
Yeah.
So you have to, one, produce a really high quality show, which I like to think that we do. I think that we get really nitty gritty in the conversations and provide great advice, and then
Yeah.
just have a promotional outlet for it, which I think is huge.
Mhm. That's awesome. That's awesome. And what is your kind of goal in 3-5 years? Where do you see your take your business to in like whatever the midterm means, that usually 3 to 5 years?
Mm-hmm. Yeah, I think about that every once in a while, and I really don't necessarily have like a true hard objective or goal. I think the goal for me is keep doing a slightly bigger deal than the last one and growing in that fashion. The big goal for me is I'd love to have 1,000 investors that we regularly work with,
Mhm.
1,000 repeat investors, and that's probably more on the tail end of that time range, a 5-year goal than a 3-year one. And
Mhm.
then for me, the other component is I want to personally own a sizable rental portfolio. I personally have about 100 doors that I own right now. But for me, the ultimate goal of getting into real estate was I want to control my own destiny. I want to, I want passive income, true passive income. And that's really hard to find in real estate syndication, where you're paying
Mhm.
preferred returns and there's equity splits, and you're beholden to the desires of your investors, right? You have a fiduciary responsibility
As
to
a
them
GP, it's hard.
as a
Yeah.
GP.
As an
Exactly.
LP, I mean, that's how you
It's easier,
think of
right?
it.
Yeah.
Yes. As a
And
passive
maybe that's the
investment.
5-year goal is
Yeah.
be a full-time LP. That sounds nice.
Yeah.
But for me, I'd love to own, 200, 300 doors that I personally own that are moderately leveraged and it's on autopilot, because I think that's what really drives a lifestyle. So
Mhm.
that's maybe the close, 3-year goal. And then on the Aligned Real Estate Partners syndication business side, I'd love to have an investor base of 1,000 investors that regularly participate in our deals, and we keep them engaged and active, and we find enough deals to service their goals, right? I think
Mhm.
that's fundamentally the objective there. And so no unit counts or anything like that. I think unit counts can be pretty subjective, and
Mhm.
5,000 units to one person who owns 1% is different than 5,000 units to somebody that's got a real significant GP stake. So I think there's a lot of conversation around that. But
Yeah.
for me, the metric is growing the investor base, because that will just ultimately lead to the unit growth, so to speak.
Mhm. Definitely. That's awesome. Well, there's so much wisdom in this episode so far, Axel. How does people find out more about you and your podcast?
Absolutely. So you can find me on Instagram at Multifamily Wealth. If you want to get on our email list, we do a bi-weekly newsletter called Multifamily Mondays, which I've gotten some great feedback on. You can just head to alignedrep.com, fill out any of the contact forms to get on that list.
Mhm.
And if you want to shoot me an email, Axel, AXEL, at alignedrep.com.
Awesome. And that's it, guys. We're going to wrap it up today. Thank you so much, Axel, for your time.
Absolutely. This was great. Thanks for the invite.
Thank you. And this wraps up for another episode of 10,000 Roads to Financial Independence.